Let's talk about the US GDP data. This framework explains why US GDP increased at a time of historically high interest rates, billions of dollars in debt, and growing fiscal deficits. The economic growth data for the world's leading economy, growth that had been very good, not as good as in the third quarter, which was spectacular at almost 5%. But even so, in a year where interest rates have risen so much and are at their highest in many years in the United States, the economy has still managed to move up by 3.3%. Here is a chart, which shows a little bit of how the GDP has increased in the fourth quarter. How this has increased in dollar terms. How the US deficit has increased and also how the debt has increased. You know that the US debt is at historically high levels, already above $34 trillion, 34 trillion in English, which is 34 trillion. Well, yesterday the GDP figure for the United States economy for the fourth quarter was 3.3%. This implied that the economy, the world's main economy, had grown in the last quarter of the year by some $328,000 million. Zero hedge indicates that in nominal terms, all the growth in the deficit and debt has nothing to do with the production growth, i.e. gross domestic product, GDP. These figures are disproportionate to GDP. Zero hedge says that in the end the gross domestic product in the United States in the fourth quarter, rightly or wrongly, ends up going up $329 billion. This figure that was given yesterday goes up $329 billion. But in the same period, the US fiscal deficit is up $500 billion. And the public debt is up 154%. If we compare, for example, what fourth quarter GDP growth was to the deficit and the US debt, we can say, to generate $1 of growth, it takes $1.50 of deficit and $2.50 of debt. This is outrageous and will not end well sooner or later. One of the ways to encourage economic growth comes directly from the government, which spends more on subsidies, for example, spending more on incentives for companies to produce, as is the case, for example, of the Inflation Reduction Act, that law that the United States put in place for green companies to go to the United States to invest money. This happens by giving incentives with money, moving the money, and making it move in the economy means that the economy will grow. Where does that money come from? From debt. Then we see it in spending and then we also see it as a consequence in GDP. This is a chain. Money is borrowed, more debt is borrowed, and more spending is done by the government, and that translates into a 3.3% increase in GDP. This explains how the United States may be growing so much when interest rates have risen to their highest levels. On the other hand, Europe, another of the great economic powers of the world, is in a technical recession, that is, 2 consecutive quarters with an economic contraction of GDP. Is this sustainable? Interest rates are rising and only large companies are growing due to the injection of money acquired through debt by the state. The money pours upwards,